Hey guys, Kelvin here. It's been a while since my last video, and so far this year, the stock market hasn't been doing very well. The Fed has been hiking rates super aggressively, and interest rates have gone up quite a bit from everything on your loans, credit cards. And so, with higher interest rates, right, that has really caused chaos in the market and have hit stocks really hard, especially for high growth stocks like the up invest kind of stocks and other speculative assets like crypto, for example. So far this year, the S&P 500 is actually down around 20%, and the Nasdaq 100, which is more tech focused, is even worse, and which is down more than 30% so far this year. So after last night's CPI numbers, which came in slightly better than expected, the stock market has surged quite a bit just last night. But overall, for the year, stocks are still pretty much down. Right. So what most investors have been doing so far this year is been selling growth stocks and rotating their money into value and dividend stocks. Right. So now investors are focusing more on companies with steady and predictable cash flows and payout dividends, instead of looking at purely just high growth. Right. So in this video, I want to talk a little bit about dividend stocks as well as look at some of the best dividend ETFs that you can consider buying this year. So if you're interested to invest in dividend paying stocks or maybe through a dividend ETF, right, this you might want to stick around for this video. Right, so this is the outline for today's video. So first up, we'll take a look at why we might want to invest in dividend stocks and also why we might want to do it through an ETF. And then we'll move on to look at the top five US dividend ETFs, and then followed by looking at one in dividend ETF in Singapore as well. And then lastly, about I'll share which one of these ETFs is actually my favorite. Right. So let's get into the video. Right. So first things first, let's look at why we might want to invest in dividend stocks in the first place. And we can start looking at the current environment and try to figure out why stocks are falling in the first place. Right. So the first reason is that with the Fed tightening monetary conditions and increasing the interest rates, right, that's causing valuation compression in many of the stocks, especially those growth stocks. Right. So valuation compression basically just means valuations are falling, and that drags the prices of stocks down. Right, but this is mainly because of how fund managers and many other institutional investors and how they value a certain stock, right? And most of them use a discounted cash flow model or DCF model, which might have heard about. Right, so I won't go into too much detail about the DCF model because that might take a really long time. But basically, what's happening is that these analysts at the funds, right, they are trying to calculate the present value of a company based on its future cash flows, and discounting those future cash flows using a discount rate, right? And this discount rate is usually based on the WACC or weighted average cost of capital, right? So as interest rates rise, right, these future cash flows are being discounted at a higher rate, and thus that results in a lower present value. Another reason why growth stocks are being priced lower is because as interest rate rises, that makes debt become more expensive. So investors are now placing more emphasis on the quality and profitability of a certain company, and instead of it's purely looking at this revenue growth. So now let's look into dividend paying companies, right? And these dividend paying companies are generally profitable companies with steady cash flows so that they can continue to sustain and pay out their dividends. But these companies are usually pretty mature and have lower growth rates. So although most of these dividend paying companies might be large and well established companies, right? But that doesn't mean that they are any less risky, right, than growth stocks, depending on the macro environment as well. So what you want to do is, if you're looking for dividend stocks, right, you want to avoid high yielding dividend stocks, which have very high payout ratios, right? That means they are paying out most of their profits in dividends, and as well as you got to look at their revenues and profits and make sure that they are not on the decline as well. So if you're looking for good dividend stocks, right, the same general rules applies to most companies, right? So you're looking for companies with a strong competitive advantage, a strong balance sheet, as well as a growing revenue. And maybe you might want to focus a little bit more on the dividend part and make sure that they have a history of growing their dividends sustainably. Right, so a little bit more about dividend investing, right? So you can also customize dividend investing to suit your style. So if you are leaning a little bit more onto the growth side, you can focus more onto looking at dividend growth of the company. Or if you are leaning more to the value side of investing, right, you can also look at the dividend yield history and look at those which are slightly higher to find undervalued stocks. So the last thing you might want to consider is whether you want to invest directly into dividend stocks or do it through something like an ETF or an exchange traded fund. So basically, the main advantages of investing into dividend stocks through an ETF is that it's more diversified because it invests into many different dividend stocks, as well as it's a more passive approach, requiring less like maintenance or time from you. So you don't have to put in a lot of hours to do a bunch of research into the individual companies, as well as the manager of that ETF, right, will do all the rebalancing for you and deciding which dividend stocks to put into the ETF. So, of course, the downsides of this is that you have no control over what are the holdings of the ETF, other than picking which ETFs to invest in the first place, as well as you have to pay additional expenses, which are indicated in the expense ratio. But usually for this kind of index funds, right, the expenses are pretty low. So since for today we're looking at dividend ETFs, right? So this is a class of ETFs which are also known as smart beta ETFs. So sounds smart, right? But actually, what it means is that these ETFs systematically use certain rules or factors to select the investments into this ETF. Like, for example, they might use dividend yield or dividend growth as a sort of filter to filter out certain stocks and put them into this ETF. Right. So now let's look at the top five dividend ETFs listed in the US. And I'm going to be using this website called VetaFi, or used to be known as etfdb.com, which stands for ETF database. Right. So looking at this ETF, this dividend ETF list, right? The top five here by total assets or AUM, right? The first one is VIG, which is the Vanguard Dividend Appreciation ETF, followed by number two, VYM, the Vanguard High Dividend Yield ETF. Then number three on the list is SCHD, which is a pretty popular dividend ETF by Schwab, and it's called the Schwab US Dividend ETF, Dividend Equity ETF, sorry. And then we have DGRO, which is the iShares Core Dividend Growth ETF. And lastly, number five is SDY, which is the SPDR S&P Dividend ETF. So what I like about this website is that it summarizes all the important metrics that I like to look at in the ETFs and makes it easy for me to compare between all the different ETFs. So they have tabs for like the performance or returns of all these ETFs, the expenses, as well as the dividends, and even the holdings of each of these ETFs. So I won't be going into each individual tab here, because because I find it's a little bit difficult to compare between the different tabs. But you can go and play around with all the different tabs and explore a little bit about this website. So what I've done is I've extracted the important metrics that I want to look at and put it into a Google sheet, right? So yeah, let's jump over to there to do the analysis. Right. So I've summarized these five ETFs into this Google sheet, right? And I've extracted the important numbers that I want to look at. So besides the AUM, which gives an indication of how big the fund is, as well as maybe its liquidity as well, I want to look at the performance, which is the year-to-date return as well as the 5-year return. Now, because this is a dividend ETF, right? So I want to focus on the dividend yield. That will be important. And then other important things like the expense ratio, and its number of holdings, as well as the percentage of the top 10 in terms of the overall weightage of the fund. So that will give us an indication of how diversified or concentrated that ETF is. Right, so just looking purely at the stats of these ETFs, right, we can see that so far for a year to date, VIG and DGRO have been underperforming so far this year. But if you're looking at a longer term, right, over the last 5 years, which I feel is more important for long-term investors, we can see that actually um, VYM and SDY are actually underperforming the rest of the dividend ETFs. And the best one over the last 5 years is actually SCHD. And looking at dividend yields, right? Actually, the lowest one is lowest dividend yield actually comes from VIG, and the highest one is for SCHD. And then in terms of cost and expenses, the top three ETFs have the lowest expense ratios of about 0.06%, which is really low. And to take note that SDY actually has a pretty high expense ratio considered for an index fund at 0.35%. In terms of number of holdings, usually I would like to see more holdings, but that is not really a great indication because it doesn't mean that the more holdings you have doesn't actually mean that you're more diversified anyway. So you can see that VYM and DGRO actually has the most holdings, around 400 plus, and SCHD and SDY have around about 100 or a little bit more than 100 holdings. So the last metric, right, actually reveals quite a bit in terms of concentration. And we can see that SCHD is actually the most concentrated fund among the rest because this top 10, right, of this fund takes up 41% of the entire fund. And the most diversified one in terms of individual companies actually SDY at 18% only for their top 10. So then let's jump over and to look at the top 10 holdings of each of these ETFs. And I've also included the ones for VOO, which is the Vanguard S&P 500 ETF for reference, right? And this would be the top 10 US companies. So I've also color coded them. Those cells colored in yellow are actually the holdings that are also included in the S&P 500. And then those in light blue are the stocks that appear more than once in any of these ETFs. So the more common stocks, more common dividend stocks among these ETFs. Right, so just a few pointers about these five ETFs is we can see that VIG, VYM, and DGRO actually has two or three holdings that are also included in the S&P 500. So these are the really big companies, right? So SCHD and SDY actually do not have anything in the S&P 500. So if you're already if you're like me and you're already holding a fund that is invested in the S&P 500, right, it would help to invest in something like SCHD or SDY for better diversification. And just looking specifically at these two ETFs, right? Actually, SCHD also includes many of these common stocks among all the other ETFs. Whereas SDY, right, will provide you even more diversification because the stocks that they hold are totally, most of them are not found in any other ETF in this top five. So basically, the top four ETFs, right, have pretty similar holdings. There's a lot of blue there. And SCHD is the only one that doesn't have any S&P 500 constituents. And then SDY, which is the number five holding, is actually the most so-called offers the most potential for diversification if you're already holding on to an S&P 500 ETF. Right, so now let's come back closer to home in Singapore, right? And the reason why I want to look at Singapore dividend ETFs as well is more for completeness, as well as to save on a possible withholding tax of 30%. Right, so if you're familiar with US stocks, right, dividends paid out by US listed ETFs or stocks are actually taxed at 30% withholding tax, right? So if you're anywhere based outside of the US, right, this withholding tax might vary a little bit, but in Singapore, it's at 30%. So whatever dividend that you're getting there, right, you basically have to take a haircut of 30%. So if you're investing in Singapore ETFs or stocks, right, you won't be taxed they won't be any tax on your dividend, so you get the full dividend. So the only dividend focused ETF that I could find in Singapore is actually this Philip Sing Income ETF with a ticker symbol of OVQ on the SGX, which is actually a pretty small ETF compared to something like the SPDR Straits Times Index ETF or ES3. So OVQ only has an AUM of about 62 million Sing dollars. As well as this ETF, right, hasn't been performing that well as well this year compared to the STI. Year to date is down slightly at down 0.3%. And even over the last 3 years, right, cumulative return is only 1.1% compared to the 6% for the STI. And then the dividend yield for this ETF is actually not that much higher than the STI ETF even. Only maybe less than 0.1%. So I don't think it's even worth. It might not be even worth the trouble or risk of investing into this ETF. You might as well invest just into the STI ETF. So if you don't mind investing into real estate as well, getting some exposure to real estate, there are other REIT ETFs you can consider on the Singapore market as well, but I won't be covering them here. Right, and last but not least, the expense ratio for OVQ is much higher than the STI ETF. Yeah. Right, so jumping over to look at the top 10 holdings of these two ETFs as well. The OVQ ETF, right, actually has four similar holdings as the STI ETF. Actually, the top four are all the same, being DBS, OCBC, Singtel, and UOB. So only the other six holdings are different. And you can see that for OVQ, right, the six holdings are more of dividend paying stocks that pay a pretty good dividend and have been either have sustainable dividends or even growing dividends, right? Whereas for the STI, since it's just weighted by market cap, so they just rank by the largest companies, right? Regardless of whether or not they pay a dividend or what the dividend yield is or how sustainable it is. Right. So which one do you think is my favorite dividend ETF? Yeah, you might have guessed it is SCHD, which is the swap US dividend equity ETF. This ETF is actually super popular among dividend investors, especially on Facebook groups. So a little bit about SGHD. It tracks the Dow Jones US Dividend 100 index, which is an index focused on looking at the quality and sustainability of dividends. If you remember, it was the third largest dividend ETF. So it's very liquid. And it's the best performing one in the last 5 years at 77% cumulative returns. As well as decent year-to-date returns around, which is because it's only down around 6% compared to the S&P 500, which is down 20% year-to-date. And it has the highest dividend yield among all the US dividend ETFs at 2.83% and a low expense ratio of 0.06%. So SHD is also pretty diversified. It doesn't have any of the top 10 names in the S&P 500, but yet all the names are pretty familiar. And yet it also has some overlapping stocks with other dividend ETFs in the top 5 as well. So the risk I see for this ETF is that it might have a slightly higher concentration compared to the other ETFs. It only has 100 holdings, and the top 10 actually makes up 41% of the ETF. So actually, personally, I've started buying into SCHD opportunistically a few months back. I'm trying to build up my position in this dividend ETF because I used to hold quite a bit of dividend stocks in the past, but I actually sold out of many of them. So I want to consolidate into just one position in a dividend ETF, so I don't have to spend too much time researching into individual stocks. Right. So if you're interested to find out more about my portfolio holdings and my strategy, as well as more thoughts on finance and investments, I write a bit on my blog. So head on over there. It's called financegnome.com. Right. So that's pretty much it for this video. If it has been helpful for you to help you decide on which dividend ETF, do let me know. Drop the video a like and subscribe, and also do share with me. Let me know which dividend ETF is your favorite. Right. So take care, guys, and see you at the next video. Bye.